One of the frequently asked questions that I usually get on my DMs and other forums is, if I had a certain amount of money, where should I be investing? Or if I was able to save a certain amount of money per month, where should I be investing? Or what portfolio can I angle myself towards creating over the long term so that I can achieve my financial goals? So in this video, I'm going to be walking you through how you can build a financial plan or even a portfolio that can guide you, maybe that can act as a roadmap for you towards your financial journey or towards achieving your financial goals over a period of 5 to 10 years. So what should you be focusing on? What assets should you be adding to your portfolio as you build your wealth over time? So if you can manage to save a certain amount of money per month, because that's what most of us can afford to do. So from our incomes, we have savings. So if you can be able to save a certain amount of money per month over time for the next 5-10 years, what kind of portfolio can you build or what can you seek to be achieving financially? So that's what we are going to be looking at in this video. I'm going to help you structure a portfolio. We are going to look at aspects of wealth creation, wealth protection, building an emergency fund, and all those factors that you should be looking into whenever you're building a financial portfolio or even coming up with a financial plan. So do stick with me as we look into the ins and out of portfolio building at a personal level or at an individual level. So I'm going to be sharing tips and some of the strategies that I use and that you can use to build your portfolio over the long term. So whenever you're building in the portfolio, or even before you start investing, you have to first of all identify or maybe fill out what you call an investor profile. So an investor profile is basically taking your financial background, your level of income, your level of debt, your age, what are your financial goals. So all these factors come into play to create what we call an investor profile. So an investor profile is what guides us as maybe financial advisors, or even if you are seeking to start investing your money in a certain platform, that's what guides you, or maybe that's what evaluates whether you're suited to invest your money in such a place, or maybe it helps you evaluate where you should be investing your money. So what are the factors that actually determine where you should be investing your money? So we're going to be looking at these factors. So one of the main factors is what we call age. So age affects greatly how we invest our money because of the following reasons. So someone who is young, someone who's just starting their career, maybe someone who's just starting in the investing journey, so they only have little amount of money saved, or maybe they still have a long way to go before they can earn more money, save more money, and invest more money. So they can afford to take more risks early on in their career so that they can seek out opportunities for capital appreciation or capital growth. But on the other hand, someone who is approaching retirement, someone who has already saved up a lot of money and they're approaching retirement, they cannot afford to lose all the money that they have saved, or maybe all the money that they have earned over the years. Because if they lost all their money that they have saved over the years, then that means they will have to rely on their dependents, maybe on their family during retirement, which is a bad thing. So age is very important. So young people tend to be more risk seeking, or maybe they try to look for opportunities that can help them grow their money more at much higher rates. And then on the other end, older people, or maybe people approaching retirement, they tend to be more risk averse. They try to avoid exposing their income, or maybe their wealth, to a lot of risks so that they can be able to preserve their income. So age is a big factor. So age influences how you invest and the assets that you select. Then number 2 is what we call financial goals. So what are your financial goals? What are you trying to achieve with your investment strategies, or maybe in the assets that you invest in? Because I always say that whatever financial goal you have, you should be able to match it with a financial asset. So before you invest in anything, whether it's a money market fund, whether it's a circle, whether it's stocks, whether it's ETFs, always ask yourself, what financial goal is this asset helping me to achieve? And if you can't match a financial goal with that financial asset, then that means you are investing in the wrong avenue, or maybe in the wrong asset. So financial goals can vary depending with your level of income, maybe your stage of life, or even just your purpose of investing, or maybe whatever goal you're trying to achieve. So some of the goals of investing include, maybe there's someone who is maybe saving for their kids' education, there's someone who is saving for retirement, there's someone who is looking for passive sources of income, there's someone who is looking for capital growth. So whatever your goals are in wealth creation, maybe with your finances, you should look for financial assets that help you achieve these financial goals. So the second factor is your financial goals. Then the third factor is what we call a risk appetite. So there are people who are risk averse, and then there are people who are risk seeking by nature. So there are people who have the willingness and the ability to take risks. So those are two things in one. So the first thing is having the willingness to take risks, and then the second factor is having the ability to take risks. So having the willingness is just the people who are comfortable exploring risky opportunities, others better maybe play it safe. Then the ability to take risk is, do you have the financial security, or maybe the financial background that can enable you to take more risk, because someone who is in debt cannot be able to be into a risk-seeking opportunities in the stock market than someone maybe who has already invested, has a large portfolio already, and has passive income sources of income that supplement his active income. So this person can be able to maybe enter into some more risk-seeking ventures and maybe explore some high-risk opportunities for them to get wealth. So we have talked about age, we have talked about financial goals, we have talked about risk appetite. So other factors that influence how you invest is your level of income, because like we all know, different assets or maybe different financial assets require different level of capital to get started with. So even though most asset classes are nowadays maybe lowering the amount required to get started with investing. For example, we have seen money market funds lowering the amount to as low as 1,000 shillings. We have seen ETFs on the stock market lowering to as low as $1, or even maybe introducing fractional shares. We have seen rates coming in to lower the capital required to start with real estate. And we are seeing all these other developments. I've even seen maybe bonds and bills plans to maybe lower the amount required to get started with investing. So even though the amounts are still small, it still requires some intensive amount of capital to realize some gains in some asset classes. So your level of income also determines, or maybe influences how you invest and the asset classes that you invest in. Then the last factor that I'd like us to look at is what we call financial literacy, because it depends with how many assets, or maybe how many financial assets do you know about, or maybe have you learned about, or maybe how many assets are you comfortable investing in. Because there's someone who only know how to invest in land and in real estate, maybe they don't know about money market funds, they don't know about ETFs, they don't know about rates, they don't know about the stock market. So for them, they only have limited options. Maybe they only have limited options for them to invest, or maybe to put their money into. But maybe someone who is well diversified, who is well versed with the financial markets, maybe they even know about how to invest in some complex assets like euro bonds, derivatives, maybe even they can do some forex trading, they know how to invest in cryptocurrencies. For them, they have more options to invest in, and it can act at their advantage because they have more tools that they can utilize to build their financial buffer, so even to meet their financial goals. After looking at some of the factors that influence or that impact how we invest our money or how we build our portfolios, now we look at some of the preambles that we must undergo before we start now building our portfolio, before we start getting serious with investing. So some of these things include: number one is building an emergency fund, number two is building a sinking fund, and then number three, there are people who are in debt as they try to build their portfolios. So how should they go about it? Should they maybe first clear their debt? Maybe how should they balance between saving and invest, and saving to invest for their future? So number one is that you must first of all have an emergency fund established. So an emergency fund is basically a pool of savings that can take you, maybe that can help you get up for your normal expenses for a period of maybe between 3 to 6 months. So for some people it makes sense maybe to be covered for more months, more so if you have only one source of income and you have more people who depend on your income. But if you have multiple sources of income, maybe you only live alone, you don't have an income, you can even have an emergency fund of 1 month to start with, or even 2 months, 3 months, but it's always good to maybe build it up over time so that you can be much well covered. Then number two is what we call a sinking fund. So a sinking fund is the first step, maybe the second step towards being more organized with your finances. So a sinking fund is just a pool of savings that helps you to cater for upcoming future expenses. So let's say you're planning to pay school fees next year, you're planning to go for holiday maybe in the next 6 months, maybe in the next 1 year, you're planning to maybe pay your car insurance in the next 1 year, medical insurance, life insurance, all these other known expenses that you anticipate to meet in the near future. Instead of going over budget, maybe borrowing money when that time comes, you can be more organized with your savings and build sinking funds that can help you during that time. Then the last thing that I talked about was deciding between whether to clear your debt first or maybe to start saving and investing. So there are a couple of ways that you can always look at this. So number one is depends with the rate, maybe the interest rate on your loans. If you have high interest rate loans, so in our Kenyan market, I would like to deem any interest rate loan that is above 12-13% to be a high interest rate loan, because you can hardly get an asset class that can give you a return of above 12% with low risk involved. So by this I'm talking about a T-bond that can give you a return of more than 12-13% at normal times. Yes, this year we have seen bonds that are fetched 17 and 18%, but this was a high interest rate environment and where the risk of default was quite high. So investors demanded for a high return to match the risk involved and also to match the high interest rate environment that we were in. But during normal times, you can hardly get a T-bond fetching north of 14%. So if you have a loan that has an interest rate of above 12, 13, 14%, that's a high interest rate loan, and it's better if you focus on paying it off fast, even before you start thinking about saving or even building an emergency fund. So if you have high interest rate long-term debts, first clear them, then focus about saving and investing. Then if you have low interest rate debt, so if you have maybe a debt that is lower than 10% interest rate, then you can start building your emergency fund and building your buffer of savings as you also clear your loan, because your loan is just, you can easily invest in some asset class that can give you maybe a return of 12, 13, 14%, where your loan is only taking 10%. So you have a 4% difference there that can give you an edge as you're getting started with your wealth creation journey. But then in some cases, it even makes more sense to maybe try to achieve both goals at the same time. So you're trying to repay off your debt, where you're also trying to maybe save up for emergency fund, or even try to build your portfolio, because sometimes it becomes necessary to try to achieve both goals at the same time, because they are both equally important, and you can still try to come up with ways that can help you maybe try to achieve both goals at the same time. Now we're going to be looking at how you can build your wealth creation portfolio and what assets you can consider into building a wealth creation portfolio, and what are the strategies that you can use. So whenever you're creating a wealth creation portfolio, there's some of the things that you can consider. So we are basically trying to maybe diversify your portfolio. That's number one. Then number two, we're trying to meet our financial goals. Then number three, we're trying to diversify away from all the known risks that you know that exist in the market. So some of the portfolios, maybe some of the strategies that I'm going to be sharing with you are the following. So number one, for me, I've always seen it suitable for any Kenyan investor to have maybe a 50% allocation in Kenyan shilling denominated assets. So this includes your Kenyan shilling T-bonds, T-bills, money market funds, the Kenyan stock market, such kind of asset classes, and also maybe your money market fund, your SACCOs. If you have any real estate or REITs, you can also put them in that category. Then you can also now have 50% in Kenyan shilling denominated assets, and then the other 50% in USD denominated assets. So 50% in denominated assets, these assets include, maybe you can have offshore stocks, you can have offshore ETFs, you can have offshore mutual funds, you can have euro bonds, you can have, Bitcoin isn't really backed by any currency, but maybe you can put it at and maybe the USD backed asset for this class, just for this example, but just to clarify, it is not backed by any currency, to be specific. So that's how maybe one of the strategies that you can use. You can always have a 50%. You can have a 50% portfolio of your portfolio in USD backed assets, then 50% in Kenyan shilling backed assets. So why are we trying to maybe incorporate this? Number one is to diversify away from what we call currency risk, or even what we call home risk that is available in our Kenyan economy. So I think last year we saw how the Kenyan shilling performed. We saw the Kenyan shilling depreciate against the USD by a rate of around 25-26%. Then this year we have seen the Kenyan shilling appreciate against the USD, or maybe recover or bounce back at a rate of, currently the last time I checked was at 22-23% year to date. So these currency movements can be quite huge, and more so if you look at maybe how the Kenyan shilling has performed against the USD over time. You're going to see that maybe 10 years ago, one USD was exchanging at a rate of around 86 shillings, but now we are at 130. Last year there's a time we got to 160. So if you really want to maybe build wealth over time, maybe it's better to consider reserving your wealth in maybe the most stable currency, or even maybe the most stronger currency, which is the USD for this matter. Okay, there are people who try to argue that maybe the USD is losing its relevance because of what you have seen called the dollarization. You have seen maybe the dollar is losing its market share of the global trade, because you are seeing other economies trying to come against the USD, but still the USD is still the global reserve currency and still the most stable currency maybe in the world, maybe one of the most stable currencies, and it will still take some time before it even gets to be thrown by other currencies. So that's number one. Then number two, you can try to build a portfolio whereby you're trying to focus on both cash flow and capital growth at the same time, because for me, I believe one of the most important factors is cash flow, because cash is what we use to maybe meet our needs, or maybe fulfill our needs. So we are always trying to see how we can maybe improve our cash flows, or maybe get more sources of passive income. So most investors are usually stuck between, do you go for assets that generate good cash flows, maybe like T-bonds, like dividend stocks, or do you go for assets that give you opportunities for capital appreciation, like maybe in the stock market, like maybe in crypto or Bitcoin? So you can always build a portfolio that can help you maybe meet both goals at the same time. So yes, you can prioritize both. You can have 50% of your portfolio optimized for cash flow generating assets, and then you can have 50% of your portfolio optimized for capital growth seeking opportunities. So for your cash flow opportunities, you can have things like T-bonds, you can have things like dividend stocks, you can have maybe rental income from real estate. And then for capital growth seeking opportunities, you can have things like your ETFs, you can have things like your stock market, you can have things like your crypto. So you can balance these assets and have a 50% of your portfolio focused on optimizing cash flows, and then 50% of your portfolio optimized on capital growth. Then the last strategy that I'd like us to talk about is what we call passive versus active investment strategies. So like I've always mentioned, active investing is whereby you're investing directly into the market, so you're buying individual stocks, while passive investing is whereby you're buying passive funds that are passively managed. This is where you have ETFs or index funds. So for us, we're going to be using ETFs for this matter. So we are trying to take both active strategies and passive strategies. So this example can also be used in the stock market rather than maybe in other assets, because this is where we maybe have much of active holding and passive holdings. So you can have your active holding maybe for your offshore stocks portfolio. You can have maybe 50% in individual stocks if you are interested, or maybe if you're trying to capital growth opportunities, then you can have your 50% of your portfolio in ETFs or maybe exchange traded funds or maybe an index fund. But for most Kenyan investors, what we have access to is ETFs. So you can try to balance out your stocks portfolio to be 50% individual stocks and 50% ETFs. But maybe just to give a disclaimer here, there's a report by Spiva, which is a report that documents how active fund managers and hedge fund managers perform versus their respective S&P benchmarks. So over the long term, the benchmarks, maybe the S&P benchmarks, have always been overperforming the fund managers and the hedge fund managers. So sometimes we are stuck between, does it really matter? Maybe does it really make sense for us as individual investors to go for individual stocks, or should we just do what we call index and chill? Just buy the ETFs, just buy an ETF that tracks the S&P 500 like VO, and just chill and just maybe preserve your time and energy doing better things than maybe trying to maybe beat the market. But at the same time, yes, you can decide to go passive 100%, but if you're young and you feel like maybe you have the edge, maybe you have the time to analyze stocks, you can still maybe try to focus, but now not go 100% individual stocks, but maybe have some exposure in active stocks as well. So that's it on building a wealth creation portfolio. So you can see my example here that I have here. You can see I have this Kenyan shilling portfolio here, whereby the Kenyan shilling portfolio here is trying to optimize on cash flow. That I have a USD portfolio here that's trying to optimize on capital growth. So you can see here on the Kenyan shilling portfolio, it's mainly the 40% in T-bonds, and then 40% in dividend stocks, and you have some money market funds. You can maybe have your circles and maybe your real estate as well. So the Kenyan portfolio is trying to mainly optimize on cash flow. Then the USD portfolio is mainly trying to maybe optimize on capital growth strategy. So here you have your ETFs, you have your Eurobond, you have your crypto. Okay, I've not included the individual stocks, but you can as well have them. But maybe for most retail investors, maybe for people who don't have the time to maybe analyze the statements, who don't know how to pick stocks, maybe you can skip that and just have your entire stocks portfolio for offshore in ETFs. So you have the active and the passive strategies as well. So that's how I will go about building my portfolio. So you can see in these examples that I have here, I have put some figures here. You can see there's 10 million shillings on the Kenyan shilling portfolio, and I have 10 million shillings on the USD portfolio, which equates to around 76,000 USD, if my math serves me right, whenever I was doing that math on the rates at that time. But you don't have to have the 10 million shillings, maybe the 20 million shillings now. You can just have something that guides you. This is just like a roadmap. Maybe this, for some people, this can take maybe 1 year, 2 years, 3 years, 5 years, 10 years, 20 years. Just serves you as a roadmap that can help you maybe guide you as you try to build your portfolio over time. So like I mentioned, it starts with saving money, or maybe it starts with earning money. So once you earn your good income, then you save a certain percentage of your income. Then after saving that percentage of your income, then you try to channel these savings into investments. So you can either have a Kenyan shilling portfolio or USD portfolio. And yes, there are still some other assets that are not included in this portfolios, because these are just sample illustrations that I'm trying to build, and you can even try to maybe come up with your own strategies that make sense for you. But these are just general classifications that I feel can work for the average person, because for most people, the most challenging thing for people to invest is maybe investing in things like maybe the stock market and the crypto market. So I have simplified that for you. For the stock market, for the Kenyan stock market, just go for the dividend kings, or maybe the stocks that have very good dividend yields over time. There's a list of those stocks. Then number 2, for the offshore stocks, you don't have to go for the individual stocks. You can go for the ETFs. Then for crypto, you can either go for Bitcoin directly and buy and buy Bitcoin, or you can still go for the Bitcoin spot ETFs and just have the advantage or maybe the capital appreciation that Bitcoin comes with by through an ETF. But now you have maybe transferred the risks from yourself to the ETF provider, because as we all know, Bitcoin, maybe investing in crypto, comes with a lot of risk. One being the crypto exchange risk, and then number one, the wallet risk as well, because you can easily lose your keys. And like we always say in crypto, not your keys, not your coins. So you want to be keeping your coins away from the crypto exchange, maybe in a safe wallet, maybe hard disk somewhere, maybe in a cold wallet facility, maybe in cold storage. So whatever place you choose, maybe whatever method you choose to invest, maybe get that exposure in Bitcoin or crypto, then you can always follow it and stay. The last element of portfolio building journey, or maybe your roadmap towards coming up with a financial plan, is what you call wealth protection. So most of us try to focus more on wealth creation and neglect maybe a more important structure of coming up with the financial plan, which is what you call wealth protection. So wealth protection is where you have things like medical insurance, so you have your emergency fund, and also how you have your life insurance. So an emergency fund, or maybe if you want to think about the wealth protection plan, you can think about this way. So whenever maybe you have an illness, maybe you are hospitalized and you need a lot of cash maybe to foot your medical bills, what happens? So for most people, they will start with the emergency fund. So whatever reserve of cash that you have in an emergency fund or in your bank account, you are going to deplete that first. Then after that, if you don't have a medical cover, or maybe you don't have a life cover that has some critical illness elements to it, or maybe an accident benefit to it, you're going to start selling off your assets. So you're going to look at maybe the money you have in your money market fund, the money you have in the stock market, if you had a bond, if you had some real estate property, if you have some pieces of land, you're going to sell all those assets so that maybe they can foot your medical expenses. But now with financial planning, we try to avoid selling our long-term assets, maybe selling our assets, because they are very important assets to us, and we try to not lose our wealth whenever we have these financial emergencies. Okay, people try to call them emergencies, but as a financial planner, I can't call them emergencies, because death and sicknesses are things that occur to a normal human being from time to time. Okay, though there are probabilities of when and how they can occur, but getting sick and death, these are things that happen. These are something that we expect them to happen in one time, or be in one stage of our lifetime. So how do you actually build your wealth protection portfolio? So the first element is what we call an emergency fund, like I mentioned, but maybe we called an emergency fund in our wealth creation portfolio. So emergency fund can fall either between in a wealth creation portfolio and as well, because an emergency fund is the first step towards protecting your assets. Because one of the importances of an emergency fund is that it helps you whenever you have a financial emergency. You don't have to sell your long-term assets, but you can just maybe liquidate your portion of your emergency fund. If you have your emergency fund in a money market fund, you can just withdraw the money you have in your money market fund, and then use it to offset your financial emergency, and then just proceed with your life as normal as if nothing had happened. So your emergency fund is the first step towards protecting your wealth. Then after that, you have what you call a medical cover. So most people who are employed, or maybe if your employer is a good employer, you have maybe a private medical cover, maybe a group medical cover that maybe your employer gives you. So if he gives you that and it also covers your family, then that's well and good. Maybe you don't have to look for maybe a private cover on your own, because maybe your employer provides that. But maybe if you are a freelancer, maybe you are self-employed, or if you are in business, that makes sense for you to maybe get a family cover for you. Okay, it depends if you have a family or not, but if you have a family, maybe it becomes much more important for you to have a medical cover, because with young kids and with yourself covered, it makes a lot of sense, because kids always tend to maybe visit hospitals, fall sick every now and then. So it's always very good to have a medical cover that can maybe help you offset your medical bills and medical expenses. And then just to mention, a medical cover can serve different people. We also have seniors medical cover. These are for maybe the elderly, or maybe people who are above 60-70 years of age. So we have seniors medical cover that can serve you maybe in your retirement. Then after that, you have what we call life insurance. So the whole purpose of life insurance is just to protect you and your loved ones. So for you to understand the importance of life insurance, you have to ask yourself, okay, if I was not there, maybe I'm the sole provider of my family, what will happen to my family, to my children, and maybe to my wife, maybe to all people who depend on my income? So that's the purpose of life insurance. So life insurance, or maybe what we call whole life insurance, it's one of its main objective is to try to replace your income when you are gone. So that's why maybe life insurance is very important. So here I have a simple chart that shows you some of the elements that you can build, that you can use, or maybe how it looks on paper whenever you're trying to build a wealth protection portfolio. So here you have a simple plan, a medical cover. You can see the premiums, the annual premiums here for this medical cover. Then you have a life insurance cover, which is a whole life cover. So for me, when it comes to life insurance, maybe the cover that makes much sense for me is what we call whole life insurance, because I believe you can take up a cover that maybe you can only pay for 10, 15 or 20 years, but then you're covered for the rest of your life. So when you're young, it becomes much more cheaper, and then you're covered for the rest of your life. And then they also come with very good riders, like maybe a critical illness rider and maybe a accident benefit rider. So what a critical illness rider does is that it pays you a certain amount of money in case you are diagnosed with a certain critical illness. Maybe it can be a certain cancer, maybe it can be maybe an organ failure, a major organ failure, maybe you require maybe a major organ transplant, or maybe some of these other critical illnesses. Then you have the accident benefit cover that as well, that maybe pays a certain amount if you got maybe a certain if you became permanently disabled maybe from an accident. So that also pays some amount of money to you, maybe to your loved ones. Then as well, we also have the death benefit, whereby it pays a certain amount of money in case you died to your family, so which also serves to maybe protect your loved ones, because it acts as an income replacement for the time being as your loved ones try to process how they are going to progress with their life without you. So you can see the chart here how a wealth protection package looks like and the elements that it has. So now we can combine everything from your wealth protection and now add the elements of your wealth creation. So now you can see a wealth creation portfolio and your wealth protection portfolio, and now you have a plan that you can stick with and that can help you maybe sustain and grow your wealth over time without necessarily having to worry about anything major. So that's it on me on building a basic portfolio. So you have tried to cover the factors that influence what you should look into. So financial literacy is very important, because some of these assets that I've mentioned, most people don't know what they are, maybe how to invest in them. So that's why financial literacy is very important. So you can always sign up to programs like ours. We have the Money Mastery Masterclass that we try to do month on month, whereby I try to maybe come up with programs and people who can teach you how to maybe invest in these assets, or even how to structure your portfolio and learn about all these things that I'm talking about. So financial literacy is very key because it influences what you know and how you can be able to act on your financial goals and build your portfolio as well. Then number 2 is your level of income. So people try to talk about cutting expenses and savings, but remember, you can only save a portion of what you earn. So if you're not working on your income, or maybe if you don't have a job, then you can't really do anything with the financial literacy that you have. So two important things. Number 1 is your level of income. So always try to look for ways to grow your income. And then number 2, financial literacy. Always look at ways that you can learn about investing in financial markets, how you can improve how you manage your money, and how you can build a wealth through investing in financial assets. So that's it on building a simple portfolio. So maybe I've tackled different elements of building a portfolio, how you can optimize for cash flow, for capital growth, and other elements of building a portfolio. So let me know which other questions you may be having about building a personal portfolio, maybe what strategies that you are also looking to develop whenever you're building your own personal portfolio. And if you have any other questions, let me know in the comment section. So that's it from me. So let me see you on the next episode of our YouTube channel. So if you like this video, give it a thumbs up, maybe comment on the comment section below, and maybe subscribe to my channel. So that's it for this video. See you on the next one.